Welcome to another Fed Day, FOMC Day edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. Thank you so much. I am Dion, Rabouin, reporter at the Wall Street Journal. This is Market Takes. We are diving into today's FOMC press conference, the statement, the decision, all that. We're going to break down what all of it means and explain why it matters. Today's meeting, I think, was a little bit more subdued, a little bit, you didn't have a lot of the big fireworks that we've come to expect from Fed Day, but nonetheless, there is some very important context that we are going to get into right here on Market Takes. We're going to talk about, of course, the Fed rate decision and how that aligned with expectations. We're going to talk through what's going on in the markets, how markets reacted across stocks, bonds, currencies, commodities, all that good stuff. And of course, we're going to talk about the environment coming into the meeting and how today's meeting and press conference and all that may have shifted things going forward. And then, of course, we will talk about what comes next, because even though it's backward-looking data, we are always looking forward. Anyway, so let's get to it. The Fed decision today, the FOMC raised rates by 25 basis points. This was widely expected, widely priced in, not surprising anybody. The Fed raising rates from 4.75 to 5% to 5% to 5.25%, effectively 5.1%. Want to put a chart up here on your screen so you can just look for yourself and see kind of the environment that we have right now. All the way on your right, you see how high that rates have gotten. We are back up above 5%. That is the highest the rates have been since September of 2007. So almost 16 full years since we've had rates this high. And you see what happened after rates were that high. They came back down pretty quick. We had a recession, as you see with there shaded in. That is not necessarily indicative of what will happen now. Past results are not indicative of future results, but we shall see. It's definitely going to be interesting. We are entering the interesting times now, the times where things get a little bit harder, a little more difficult for the Fed, for Fed Chair Jerome Powell. So that chart is kind of illustrating where we are in terms of the Fed rate and how that compares with recent history, at least over the past 20 years. A big thing that I think was interesting from this report, and my biggest takeaway in terms of the statement, was the change that instead of saying there's some additional firming ready that could be done, the statement now says the Fed is determining the extent to which some additional policy firming may be appropriate. RSM chief economist Joe Bruce said they were, quote, opening the door to a strategic pause at the June meeting. Basically, that was market's takeaway. The Fed said that they were going to kind of reassess, reevaluate. They were going to hike today. But at the press conference, even Fed Chair Jerome Powell said the changes in the statement were intentional. They made those changes to say, look, it's time we kind of step back. We've been raising rates every meeting, 10 straight meetings. They've increased rates, including raising 75 basis points, 3 times the normal pace at 4 meetings earlier this year. So some big changes were made, and now we're entering a new phase of this rate hiking cycle. And that's what I think you're seeing the market respond to right now. Coming into this meeting today, things have been pretty straightforward and easy, right? Now, it's not necessarily easy to raise rates because, of course, markets want low rates, but with inflation being high, it got up to as high as 9% in June. Of course, the Fed has to raise rates. It's pretty simple. Inflation goes up, the Fed has to respond by raising rates. They put it off in 2021, saying transitory. We think it's going to go away on its own. When that didn't happen, it became clear they had to raise rates. They did that. Now we're entering the phase where it's not going to be so easy anymore. You had high inflation, low unemployment. Well, in that case, you raise rates. It's very simple. And the unemployment rate didn't pick up very much as they've been raising rates. What you were starting to see in the data, and we'll get more into this in just a second, is the unemployment data starting to move in the opposite direction. You're seeing job losses start to pick up. You're seeing inflation start to come down. And now the Fed really has to make a hard choice or start making some hard choices in the next few months. So the Fed was really setting the table for that coming into today. Now, we had seen an environment where stocks had been rising. You saw the S&P 500 up around 7% year to date. It had been up it had reached a pretty high point recently. NASDAQ up about 15%, hitting its highest since September 12th, 2022 on Friday. Really, almost all of this growth happened in January, but we have seen stocks picking up, bond yields on the other side going down. That, for you layman's out there, means an easing of financial conditions. When they say financial conditions easing, easing, that's what they mean, making it easier for companies to issue stock because stock prices are high, or to borrow money because bond yields are low. That makes it cheaper to borrow. That's what we're seeing right now out there in the economy for big companies. And we are starting to move into an environment where things could be a little tighter, a little more uncertain as we go forward. So want to throw up another thing on your screen right here, and this is the Fed's balance sheet. Now, what you've seen over the past few years is you see the balance sheet just pick up and hit these extreme levels where we're passing 5 trillion, 6 trillion, 7 trillion, 8 trillion, getting almost to $9 trillion. And then we had what was known as QT sort of start to begin late last year. And then when this banking crisis happened, you see that pickup there right at the end, and that was the Fed injecting another $300 billion into the system, into the banking system, to try to stem these outflows and worries in the banking sector about collapsing and some contagion in terms of banks. A lot of loans made to big banks, a lot of buying up of bad assets. But now we are seeing that reverse again, and you're seeing the line starting to point down. We're seeing the beginning of QT again, aka quantitative tightening. That just illustrates the way the Fed's balance sheet has moved long term, and we are entering a phase now where the Fed doesn't have the wind at its back anymore. Instead of putting that injecting money into the financial system as they had been doing, getting that balance sheet all the way up there to near $9 trillion, we are, in theory at least, going to be moving down where they're taking money out of the financial system while holding rates high. And that is going to weigh on the economy. So like I said, the easy part is over now. We are moving into the harder part. I want to put one more thing up here on your screen, and it's just some more economic data. This is the comparison of job openings versus unemployed people in the US. And Fed Chair Jerome Powell has mentioned this a number of times. He said, just today during his press conference, there's still 1.6 unemployed people, or 1.6 job openings for every unemployed person. So even if we found jobs for every single person counted as unemployed in the country, there would still be millions of job openings left over to be unfilled. Keep in mind, whether someone is unemployed or not does not determine whether they are unemployed. That doesn't make any sense. Here's what I mean by that. Someone could be out of a job, but if they're not actively looking for a job, if they are not telling the Bureau of Labor Statistics, I am out here looking for a job and I just can't find one, if they're not checking in with some sort of government agency saying I'm looking for a job, they're not unemployed. They are out of the labor force. And what we have seen is a significant increase in the number of people out of the labor force just not being counted. A lot of those people, working age people between 25 and 55, so-called prime age workers, they are not unemployed. They're just out of the labor force if they're not looking for a job. So the number of unemployed people has been declining pretty significantly over the past 20 years, and we saw that speed up after COVID. So again, you're seeing the number of job openings decline, but there's still a lot of job openings out there, a lot of a lot of people looking for workers and a lot of work to be done. This chart illustrating that trend, but you're seeing a decline in the number of job openings, and you're seeing that number of unemployed people stay pretty steady, because while some people are coming back into the labor force, other people are getting laid off, and that's why we see kind of that line not really moving. So now let's take a look at the market right now, and let's take a look at what we're seeing from stock prices. Now look, we've got this overview. I'm checking out commodities. I want to take you back to the overview, and let's look at the stock market. This is the Dow. You're seeing the Dow down about 0.8% right now. Compare that to the NASDAQ, down about half as much, but you see the same trend, right? Whether you're looking at the Dow, the S&P 500, or the NASDAQ, all three. This is the Dow, and you see right around 2 o'clock when the Fed releases its statement, the market picks up, and then you see the statement come on. The press conference starts about 2:30, and then you see things just really start to unravel, and the sales just pick up, and people are selling out of those stocks. I think this is just a little bit of a buy the rumor, sell the news. Folks expected this statement to be dovish. Folks expected the Fed to raise rates by 25 basis points. And when I say dovish, what I mean is the Fed saying, okay, we think things are going to be easier. We are leaning towards keeping rates lower or pushing rates lower in the future. The market has priced in that the Fed is going to start cutting rates later on today. And what we're seeing right now, I think, illustrates the expectations from markets and from investors that the Fed is going to start moving away from raising rates, moving towards cutting rates. We see that with Fed fund futures prices as we look out across the market. And we're seeing it with commodity. I think the big moves that we've seen over the past couple days, oil prices are down about 10% over the last couple days. You're seeing that, and that was why we started off with commodities prices. Oil down big, natural gas down big. Those commodities, which are very sensitive to the economy, are starting to move lower in a drastic and significant way. We aren't seeing it in stock prices yet. We've seen it in bonds, in the bond market over the past couple weeks, but we aren't seeing it in stocks just yet. So definitely something to keep your eye on. I think what we're seeing right now in commodities is important and definitely worth watching. So let's talk about the press conference really quick, because that was something I think that, there weren't a lot of fireworks, as I said earlier. There wasn't any big blowout bombshells from Fed Chair Jerome Powell. He really just kind of laid it out. We think now is the time to pause. We're going to be data dependent, meaning that depending on what happens with the data, we will act. We can raise rates, we can cut rates, we can keep rates where they are. But I think right now the bias for the Fed, based on what we heard from the chairman and what we read in that statement that came out around 2 o'clock, is that the Fed's bias is to hold pat, not raise rates, not cut them, but to just hold them here at this very high level. The market does not agree. The market thinks that we are going to get potentially another increase in July, and then a cut in September, a cut in November, and a cut in December, as the Fed starts to ease up on those financial conditions again. Remember, financial conditions were eased by the Fed pumping money out into the economy, into the banks, even though they didn't engage in any quantitative easing or cut rates. When the Fed pushes money into the banking system, that eases financial conditions, makes it easier for banks to lend money to those small businesses, to do more borrowing, and to get the economy flowing. Now they are reversing all that, as we saw with the Fed balance sheet chart I put up here on your screen a little earlier. All of the things the Fed has done to ease financial conditions are starting to come off, and that likely is going to affect markets soon, and certainly is going to affect the real economy. And so today's press conference, today's statement, I think really just set in motion, all right, we are resetting where things are, and now we're moving into this new phase of the economy, of the job market, and all that good stuff. But again, it will be all about the data. The Fed says they are data dependent. Believe them, because if the data comes in surprisingly, if the data comes in above expectations, below expectations, you can expect the Fed to react, and you can expect markets to react to that. That takes us to our next point really well, which is what comes next. Well, tomorrow we get the Challenger Job Cuts Report. That comes out early in the morning. You're going to want to check that out. That's from private agency Challenger Gray & Christmas. They track the number of layoffs, aka job cut announcements, aka job cuts. That has picked up pretty significantly as we've started and moved into this year. We have seen a 400% increase in March from last year where job cuts were, and we'll see if layoffs continue to pick up steam. That's not great news for the economy. Then on Friday, we get the jobs report. We will be right here for Market Takes, breaking down what we've seen and what to make of that job report. Fed Chair Jerome Powell pointed out during his press conference today, there's been an average of 345,000 jobs added over the first 3 months, the first quarter of this year. That is a very high pace, a very fast pace, and the Fed wants to slow that down. They want fewer people getting jobs. They want fewer raises. They want less wage growth among the folks in the economy. I know that sounds strange, but that's what they want, because they need to slow inflation down. So Jobs Friday is going to be big. We hope you'll be with us right here on Market Takes. Then next week, we've got our look ahead on Monday. Again, Market Takes, baby, don't miss it. And on Wednesday, the other big kahuna coming out will be CPI, the Consumer Price Index. That report is going to tell us what's going on with inflation, and all eyes will be on that as the Fed moves back towards its data-dependent stance. No more, we can't just say, okay, the Fed's going to raise this month because, that's what they've been doing. That's all over. We're moving into a new regime where a report like CPI, the jobs report, PPI, any number of reports, the economic cost index, could move the Fed to raise, cut, hold pat, and you're going to want to watch that data, because that's going to be big. That's what the Fed is depending on moving forward. Anyway, that's going to wrap it up for us here on Market Takes. I'm your host, Dion Rabouin. I know you could have been anywhere in the world, but you're here with me. I hope you'll do it again on Friday when we come back right here for another edition of Market Takes.